Thinking about selling your business? Don't let hidden sales tax liabilities cost you at the closing. I'm Bill Lowe.
And I'm Monica Miles.
And we're Miles Consulting.
Imagine that you and your team have built this very successful business and you're finally at the table with an M&A transaction and you're getting ready to make the deal.
But the due diligence team for the buyer is also at that meeting, and they bring up sales tax liabilities that have gone undetected by your company.
And we see this all the time in our business. We've helped many clients with this exact situation. This is a very common situation because a lot of businesses aren't aware that they've triggered nexus in a state or that their products and services are taxable in a state, and that might just come up in a due diligence situation.
This could derail your deal, but there are things you can do about it, and we're here to help.
What we typically do is start with figuring out what the actual liability really is. Again, many times we represent the seller, and so they have to come to the table with a new estimate because the buyer's estimate is often going to be high on exposure, right? What we're trying to do is say, well, here's what the real exposure is. We often represent sellers who just haven't been through this before.
Buyers are looking to not take on the liabilities of the seller, and when the liabilities are raised in the due diligence process, it can reduce the selling price ultimately, or there can be money set aside, escrow account for future payment. But at the end of the day, they're trying to not take on the liabilities of the seller.
And that's why they often estimate high. And that's where it's up to us to help the seller to find out what the true liability is so they get as much money out of the deal as possible. The typical things that come up in an M&A transaction and a due diligence is that there are unfiled taxes. So the target is not filing where they need to be, maybe where they haven't identified where they have nexus. Also, a typical area of concern is missing exemption certificates. So a company might think they sell a lot for resale, but they don't have those resale certificates. That can be a real problem in case of an audit down the road.
Another common area is the taxability of your products and services has not been categorized properly.
We see this often with SaaS companies and software companies. So oftentimes a SaaS company will be on the table and they didn't realize that their products and services were taxable in several states. That's a good example of a misclassified transaction. Ideally, we would recommend to our clients that they deal with these issues before they're in an M&A transaction. We recommend doing a nexus and taxability review to make sure that you're filing where you need to be filing and get those liabilities taken care of before you get to the table. But that doesn't always happen.
Having your positions documented, well documented, and being able to present those to the due diligence team at the time of the deal is you're in a much better position than having to be reactive to a due diligence team's report and you've come to the table unprepared.
That said, though, we can help at the time of the deal as well. We're often called in right before a deal closes, and then we can help even after the deal is done, helping the seller to mitigate those exposures and doing voluntary disclosures and other back filings to get them where they needed to be, again, to hopefully get as much of that holdback back as possible and maximize the sale price for the seller. So if you're preparing for an M&A transaction or you're in the middle of one and you think you could use a little help, please give us a call.